event. Today's Market Insight webinar is intended for educational and informational purposes only, and participants shall not take it as financial or investment advice nor a trading signal. The accuracy and reliability are not guaranteed. So Pew Prime and I hosting the session are not liable for any losses or damages resulting from the use of the information presented today. Participants are responsible for independently verifying information and considering their own financial goals and risk tolerance. All right, this is the disclaimer. Right, let's start. Okay. So you guys can see from the topic itself, today we're going to talk about the geopolitical impact predictions that I can think of that might going to happen. And I think I cannot say 100%. I think maybe 90% is going to happen in 2024. And also the relationship with all the pairing or the asset classes that we mostly going to pick, right? Right, these are the things that we're going to cover. So obviously the first thing is the Middle East tension. Okay, of course, I know recently we have some latest updates of that regional event. And also moving on, we will talk about the China economy recovery challenge. And third one, we will talk about the Japan monetary policy. And also lastly, the global economic performance challenge. And at the last, I will also give you some highlights on the upcoming economic calendar. So what are the events that you might want to pay attention on? Or if you don't want to trade on news, you're afraid of the high volatility. So maybe you also can mark down those dates, and then maybe you can stop trading on that particular day. Okay, that is also depends on your risk appetite. If you love risk, you love high returns, then you might give it a try, give it a go. Okay, that is all depends on you, right? So yep, first thing is the Middle East tension. So we all know, right, this is not a new story because this happens nearly like half a year ago. So, but I want you guys, sharing this to you guys is unless you are like you apply like scalping trading strategy, like you just opened your position for a couple minutes and you just satisfied with couples of pips, right? 10 pips, 20 pips, then you satisfy, you close your position, then you can ignore all this kind of thing. But if you love to have a swing trade for your strategy, you want to hold your position longer, you want to avoid those small, you maybe apply you open a smaller position but you hold longer, then you hope that you can capture a bigger trend or bigger potential profit. Then these are the things that it might matters to you. And also I want to update some of the the events and what's happening now. So in the future, when you see some of the related news comes out, related stories comes out, then you can have your own analysis whether or not it's like how is this thing, how is this story, how is the news, the narrative is going to have an impact on those related asset classes, right? So yeah, first thing is the Middle East tension. Okay, this is not a new thing, and we all know like when there's a war happening, the first thing that the two things that will definitely have a strong impact will be the commodity. So definitely involving gold and oil. So these two commodity will tend to shoot up when there's a war outbreak. Okay, this is from textbook. And other than that, okay, not very directly will impact on the US dollar and also maybe Japanese yen, because these are when we call it a safe haven currency. And some of the trader or investor might even go to Swiss franc. Okay, Swiss franc also has been relatively stable. So when there's in the world, in the markets, when there's a lot of uncertainty, so these are the currency that people goes to. But other than that, of course, the most they'll have the biggest impact will go to gold and oil. So yep, I mean at the moment we know the US Secretary of State or State Secretary Anthony Blinken. So he himself is flew to Israel, and they are in a talk about the ceasefire, right? And then I hope that I really hope that this will come to an end. I mean the tension between the Israel and Hamas, the war in Israel can stop it anytime sooner. Okay, so these are the things that will drive gold and oil high, especially this happened in the Middle East. We all know in the Middle East region is one of the biggest oil supplies in the world. So when it's just happened, it draw the concern for in the markets that maybe we will have temporary oil disruption. So you can know actually oil price shoot up. But you remember this one actually happened in the first week of October. So maybe we shall have a look at what happened for the oil price at that time. So before it happened, right? The story behind the oil market is that the China is not doing well, and the demand outlook has been a concern for the markets. People perceive that in the time to come, the world will have excessive oil supply in the market, where the demand is not so high, but the demand is the supply is ample in the markets. That's why the oil price actually went like lower and lower, and then until October. First week of October, I remember it happens in the weekends, and then the oil prices actually shoot up on Monday itself when Asia markets time open. Okay, so I think within 2 weeks the oil price actually shoot up by nearly 10%. But this is far worse than what the market is expecting, because it's one of the most intensive war outbreak between Hamas and Israel. Because we all know this story, this is not a new thing. That I think they have the conflict since early of 2000, right? But the one that is just happened, the latest one is the one of the most intensified conflict in between them. That's why in the market, even including me, I thought the oil price can again touch the highest level, but it didn't happen, and then it gradually goes down, because after that market sees that it actually has not going to have an impact in terms of oil supply. So that's why next time, of course, touch wood, we don't want this to happen. If there's any war outbreak, then this is one of the assets that you can go to. You can consider to trade on oil. Okay, you can see this the opportunity is quite high, and the risk and return, the reward is also quite satisfying, I would say. Okay, and the next one is the Red Sea conflict. So this is also a bit related to this Israel and Hamas war. So, but this one happened like a little bit more than a month after the Israel and Hamas war. So it happened in November, I think 10 plus of November. So what happened is, because we know Red Sea is in the region, like, because a lot of shipment, they have to go through this Suez Canal. So after they go through Suez Canal, they will reach this Red Sea. So and then this Iran-backed rebels group, they call it Houthi. They start to attack the ship in the Red Sea, and then also they targeted those oil tanker, the vessel. So this is another round that you can see in November. I think 10-ish of November, and we have another shoot up of the oil price. So this is when the Red Sea conflict happened. So next time, if you come across this kind of event, then you know what to do. You know what to trade. Okay, this is the same. But after that, of course, I want to share this with you guys also. In general, in the longer run, in the bigger picture, I think now the oil markets will still just concern about the long-term oil supply and long-term oil demand in the markets. And now at the moment, if you can see, oil prices is now currently have a very strong resistance at below $80 per barrel. And why does it happen? One thing is, even OPEC itself, they say they are really concerned that the oil supply will be it will be more than enough for the oil demand in the world for the consumption. Because one thing, at the moment we haven't seen any convinced evidence that China has recovered in terms of economy to the level of the pre-pandemic level. Okay, and secondly, although we know now OPEC they really they already put in effort to try to stabilize the oil prices by cutting the oil supply in the markets, try to boost the oil prices, right? But we all know that those are non-OPEC countries, including Brazil, including US, they are going to supply more oil to the market. And also including Russia. Russia, they vow to cut their oil supply, but for people who knows, like people who observe the movement of Russia, they see that the oil shipment from the oil export from Russia is actually not matched with what they promised to do. So meaning to say they actually supply more oil than what they promised. Okay, adding to that, and also at the moment in the whole world, we are in general having this high interest rate environment, which means that the cost of borrowing is quite high. So when we are in this high interest rate environment, we are actually is actually discouraging the economic activities from happening, which is mean that we will demand less oil. Okay, so the conclusion is in 2024, what the market predicted is we will have more oil supply than oil demand. That's why now the oil prices are kept at below $80. Okay. And also, yep, the third thing is the Russia-Ukraine war. We all know it's happened in the early of 2022, but I guess it is still ongoing. There's still like on and off. People are still like fighting between each other. Okay, so this the Middle East tension is the thing either or the events that we are concerned. So if any latest updates happen in that region, then we can straight away go to have a look at the gold price and also the oil prices. If later on, because we all now they are ongoing, have the talk on ceasefire. Okay. Excuse me. Yep. So if anything gone haywire, if after some document is signed, but then after that they still open fire with each other, then we can know at the moment when the news came out, it will definitely drive the oil price and also the gold to goes up. Okay, so yeah, I'll share with you guys. I'll just show you what happened with the gold price in October. See, you can see after the war outbreak on 7th of October, gold price just crazily going climbing up and higher and higher. And also that happened to November. So November 10-ish, when there's a conflict in the Red Sea, it leads to a rebound for the gold price, continue to climb higher and higher. Okay, these are the things that are going to happen, and it might going to happen again. Okay, if any wars going to happen in the future. Secondly, like I say, the things that are going to affect our trading will be the China economy, because we know China is the second largest economy in the world, and the fact is China is the one biggest oil importer in the world. So China economies, I would say it does affects everyone in terms of our trading and also the global economy. Okay, so since January of 2023, the China government actually shift from COVID zero policy to focus more on economic growth. So previously they want to end the pandemic. So what they do is they have a lot of measures. So they don't want the virus to spread, right? And they they stop all the economic activities from happening. So during that time, we all know, of course, oil price will definitely being hit by the Chinese government policy. And also at first, when the China government announced their policy, so they want to end this COVID zero approach. They want to turn focus to their economic growth. It is a good news. And then people predict that maybe the second or the third quarter in 2023, it will lead to a strong rebound for the oil and oil prices. Because when China opened up the markets, they will start doing trade with the world. When they need to manufacturing a lot of things, they needed oil. They will have a high demand of oil because they need the energy to produce things, right? But it didn't happen. If you look at the China PMI, so we all know if you look at the PMI reading, it has to be above 50. Above 50, it means that the economy is expanding. If it's below 50, it means that the economy is contracting. Right. So you can see this is from September 2023, October, November, and December. It has been kept at below 50. So it means that this is, from the side shows that the China economy is not recovering. Okay, this is one. And secondly is the China CPI. Of course, we all know now UK, US, Euro, Australia, New Zealand, you name it, everyone are actually fighting for a high inflation. But the story is different in China. China actually they want some inflation because if the economy is not expanding, when people are not demanding for more, they are not spending money, it cannot lead to inflation. But this is what the China actually want. So I know throughout 2023, I think at least 3 times the Chinese government have been deliver some economic stimulus package, including lower down the bank deposit ratio, including lower down the short-term interest rate, okay, including they use the government money to spend to channel it to the market, try to boost the economy. But until today, there's still no any convincing evidence or economic data to say that the China economy is recovering. Okay, and the second thing is the credit rating agency Moody's actually downgraded China credit outlooks a few months ago. So we know people from the outside, okay, they are not very have a confidence in this China economy. That's why this credit rating agency downgrade their credit outlook. And the third one, which is quite huge, is the property sector woes. So it's a ticking time bomb, leading by I'm not sure any of you know about this, which is the Evergrande. So Evergrande was one of the biggest property developer in China. So I think they're having a debt in terms of trillion. Yes, trillion. So they might go bankrupt and it will affect a lot of people or affects the financial markets in China because this is too big and it's like a too big to fail things. Something like what happened in 2008 when Lehman Brothers bankrupt. This is something like this. And I think the government don't know like how to deal with this because this is too big, because it's talking in terms of trillions in debt. So yeah, we don't know this when this is going to happen. And not just Evergrande, a lot of big developers, I mean the property developer, they are still having difficulties. And also the property value, the variations, things like that is still also very complicated in China. So this is one of the biggest concern also for the entire financial markets. Okay. So I would say at the moment, China economy is still things that we have to concern. And why? What things that we can look at is two things. This will have a very direct impact. The first one is the Chinese proxy currency. Okay, so normally because normally we don't look at the China yuan, the China currency, or some people call it the renminbi, RMB, but we don't trade that because the liquidity is quite low. Okay, but mostly people will trade on Australian dollar as well as the New Zealand dollar, right? So this we call a China proxy currency, these two currency. Why? Because we know Australia and New Zealand, their currency, we call it a commodity currency. Why? Because they export a lot in the past. They export a lot of their raw material like irons, some things like that. And China has been their biggest trade partner for Australia and New Zealand. So when the China economy is good, they will import more. So they will import from Australia and New Zealand. So when this kind of when you read on the news, they say, oh, China economy is recovering. They have having a slightly higher CPI. Okay, next time if you read on this China economic data, if you look at the China PMI, if you look at the China CPI, okay, if the reading is better than expected or even better than the previous reading, then you might want to try to trade on the Australian dollar and also the New Zealand dollar. Okay, because this factor that will affects the performance of the Aussie dollar and the Kiwi as well. And the second thing is that what I said just now, the crude oil prices. Why? Because China is the biggest oil importer in the world. They import the most oil, followed by India. So yep, if China economy is good, they will tend to demand for more oil. So when they demand for more oil, it will drive the oil price higher. So these are the two asset group that we can look at if you have any updates on the China economic performance. But vice versa, if the economic performance in the China continue to be gloomy, you know what to do. If you want to trade, have a swing trade, especially on the crude oil, on the oil prices. If the China economy continue to be gloomy, which means that the demand outlook in the entire 2024 is not going to be good, then you might just open a long-term short position on oil. This is one of the example. You don't take it, you don't take my word by word from me. Okay, you have to do your own analysis as well, and then you apply technical analysis before you open a position. Thirdly, we will discuss on the Bank of Japan monetary policy. Okay, so this has been the story since last year, towards the end of 2023. So what they has been discussing is in October, November, December, because previously they have this YCC. I'm not sure whether you guys have come across this. They call it yield curve control. So it's to put it simple, is the BOJ, Bank of Japan. They want to manipulate their bond yield. So indirectly, it's just something like they want to manipulate the interest rate in the country. Okay, you can understand it in this way. And also in I think October or even earlier than that, the BOJ actually tweaked the YCC to go higher. It means that they are preparing, the market perceives as this, they're prepared to have a shift in their monetary policy. So for for decades long, the Bank of Japan have actually restrict their interest rate to go below 0%, which means that they have a negative interest rate. Like this is like one, I think the only country that having a negative interest rate in the entire world. And also why they're doing this is because they want inflation, unlike the countries that I mentioned earlier, UK, US, Australia, Euro. They're having a very high inflation, but this is also not the story in Japan. Japan, they actually their economy is quite stagnant, so they want some inflation and to boost the economy. So they have this negative interest rate. So they think that this ultra loose monetary policy has already have their effect, is effective, and they want to tweak it, they want to shift it, and they will start to increase the interest rate in the future. So when the BOJ first tweak their YCC, it's like a hint or a signal for the global market to say, hey, we might have a chance to shift from this current ultra loose monetary policy. So people are expecting a boost in terms of Japanese yen strength. Okay, so if the BOJ increase the interest rate, the Japanese yen tend to appreciate. It will go strong. Okay, if you trade on the USD JPY, it will go down if the Japanese yen is strong. Okay, and then before we step into 2024, the market actually expecting the BOJ will have a move in January itself, but things just didn't happen. So I highlighted this. This is the January 2024. So if you have a look at the BOJ core CPI, so it has been quite good because the BOJ target is at above 2%. So it has been quite good, like 3.4, 3.0, but 2.7 and 2.6. We can see that the trend is gradually go lower and lower. So this is what's the BOJ concern. Is this a fake inflation? Is this because of the imports pricing inflation, which is they don't want to see this. They want a sustainable inflation before they make a move in terms of monetary policy. And then also another thing that they concern is the wage growth. You can also see that the wage growth has actually gone to below 1% in January 2024. And also for the Japan retail sales. So Japan retail sales is mean that the retail, the general people consumption actually fall to 2.1%. Okay, from the October 5.8%, which is have a jump, have like a 50% discount already in January. So this is why BOJ at the moment still haven't made any move yet. Okay, but what we can know is they already released their January BOJ meeting minutes. So in the minutes, actually, their board member are quite looking forward to start to increase the interest rate because they want to do it before those other major central bank to start cutting interest rate. They want to do it before them. So if they start to increase the interest rate, you can expect the UJ pair to go down because Japanese yen will appreciate, will goes up, will strengthen the Japanese yen. Okay, but when will they do it? So these are the I would say three very very important economic data that you have to look after every time. If you compare to the January, if you know in February, you see the number come much higher than this compared to the January economic data, then you can maybe try to trade on the Japanese yen. And we think that, oh, maybe after the BOJ look at this data, it will convince them to have a shift in the monetary policy. They will start increase the interest rate, and then they will boost the strength of the Japanese yen. Okay. Or maybe I'll just share some of the technical analysis for the UJ pair. Okay, a simple, quick one. Okay, you guys might observe that here we'll have a very, very strong resistance level over here, right? Because it touches here 3 times already at this level, which is at 148.7, around this range. So if you guys have a bullish bias on the UJ pair, you might want to wait until it firmly break above here then it will have this will give you a very solid bullish signal for the UJ pair, and then you can open a long position here. And the next one is, if you can see, they will have a solid support level over here. Okay, it touches here a lot of time, and this is around this range, which is around 146.5. So if you can wait, if you break below here firmly, strongly, sustainably, then it will serve you as a bearish signal for the UJ pair. Okay, if you break below here, you can expect it to go down. Okay, so this is a very brief technical analysis that I can share with you, right, for the Japanese yen. Okay, moving on, we'll talk about the global economic gloomy outlook. Okay, like I say, unlike China and Japan, others major economy, including US, including the Eurozone, including UK and Australia, New Zealand, they are having a very high inflation rate now. So at peak, they're having like double-digit inflation, like 10%, which is very crazy. So what they do is the central bank actually started to increase the interest rate more than a year ago, and it's a very sharp and steep interest rate, especially the US. So the Federal Reserve now have the Fed rate at 5.25 to 5.5%, which is one of the highest level in the history, and that's why it leads to a very strong USD now, and also followed by the UK, the BOE, Bank of England, and also the ECB, the European Central Bank. They actually just keep increase the interest rate. But what is the aftermath of this? One thing is resulted gradually softening inflation, but it's followed by a potential economic recession risk, which is they don't want to see. They want to avoid it. So if you look at the CPI, you can compare it in 2003 and 2004. They achieve a very significant result in terms of taming or control the inflation rate. So the CPI is one of the economic data if you want to know the inflation rate of a country. So for US, dropped from 6.5 to 3.4, UK from 10.5 to 4, and Euro from 9.2 to 2.4, which is a very good result because they're having this monetary tightening policy by lifting up the interest rate. But moving on is the GDP. US still okay. US economic performance is quite good. Is not affected by the high interest rate. But what happened to UK and Euro is their GDP is going down. It start to move to a contraction in terms of economy. So which is they are now very concerned. And also the unemployment rate. UK and Euro, they are having a relatively high unemployment rate. US is on the border. It's still acceptable, 3.7. What they don't want to see is 3.9. They don't want to. They have the unemployment rate at 3.9. This is what they don't want to see. So I show you guys. This thing is, in this year, there's a high chance for these three countries, their central bank to start to cut the interest rate. Okay, so you apply the theory accordingly. If they start to cut the interest rate, what will happen is they will lead to a depreciation in their currency. Okay, if US, the Federal Reserve, start to cut the interest rate, it will lead to a depreciation in the dollar. And if you apply it accordingly, other currency, you go against other currency will appreciate, and the USD will depreciate, decline. Okay, same go to UK and Euro. So at the moment, ECB is the one that have the closest CPI to their targeted 2% of inflation rate. So, and also their GDP, their unemployment rate is not good. It's not beautiful. So they might be the first one to have the first ever rate cut in recently. And also for the ECB, they will have their interest rate decision in March and April. So you guys can watch out and see what they say after they announce the interest rate decision. Okay, at March and April. But for US and UK, especially for US, it is least likely the Federal Reserve will start cutting rates in March, but they will not have interest rate decision in April. They will have it in May. So May is the date that you want to watch out. If they are satisfied with the current inflation rate and they want try to avoid the US economy to get into recession, they might want to start cuts the interest rate. So this might happen in May. If they do it in May, it will lead to a depreciation in the dollar, the DXY, and you can apply it accordingly. If the dollar drop, other currency will appreciate, or also including gold price and oil price if you're trading XAU and US oil, okay, denominated in USD, they will tend to climb higher when the US dollar drop. Okay, so moving on, when they announce CPI, when they announce GDP, when they announce the unemployment rate, including the non-farm payroll, these are the things that you want to watch out. Are they going to scare the central bank? Is the GDP going to drop a lot and then will scare the central bank and they might want to consider an earlier rate cut, interest rate cut or not? Or is the CPI drop more than what they expect and the GDP maintain, unemployment rate maintain? Then they might be not so soon to talk about cutting interest rate, and they will lead to appreciation in the dollar or other currency like the sterling or the euro. Okay, so when moving on, because this is the concern, because we have a very high interest rate previously, 5% for UK as well. I think nearly 5% for the ECB. Okay, if they, because of this high interest rate, they are discouraging economic activity, which is the aftermath result slowing economic growth. Okay, and they don't want this to be persisted. They don't want this to continue, and they might want to start cutting the interest rate. So this is one of the biggest theme in 2024. And also, if they start cutting interest rate, it means the cost of borrowing is lower. It means it's easy to do business. It will lead to a higher oil price as well. Okay, you guys can also consider to have a look at the oil price. Okay, these are the concerns. Lastly, the economic calendar. So this is up to next week. Okay, this is the key economic data that I highlighted for you guys. Okay, for the US dollar, we have a job data and inflation rate. Okay, is the data that watch out. Okay, for initial jobless claim Thursday, which is tomorrow, and also next week, next Tuesday, we have the CPI. So you know what to look after. If the initial jobless claim came very high, it means the unemployment rate is getting higher. It will be the concern for the Federal Reserve, and also the CPI. If the CPI is higher than the market expected, it means the interest rate will stay for longer. But if the CPI start to drop quite significantly, then the Federal Reserve have a higher chance to start cutting the interest rate earlier. Okay, and the next one is the key is the UK GDP, and also right this one is for you guys to gauge the economic performance in the UK. So if the economic condition is still healthy in the UK, maybe the Bank of England might consider to maintain their interest rate at the current level. But if the GDP drop significantly, then it will scare the BOE, the Bank of England. Then they might want to consider an early interest rate cut. Okay, so this is the highlight for these 2 weeks, for tomorrow and until next Thursday. And these are the economic calendar that you might want to watch out, and then you apply it accordingly to your day-to-day trading. Okay, here is the end of our session today. So if